Hello traders and welcome back to the Forex Geek. In today's video we're going to be talking about a powerful EURJPY trading strategy that you can use to take advantage of the volatility in this popular currency pair. So whether you're a beginner or an experienced trader, understanding how to approach EURJPY can make a significant difference in your trading results. So by the end of this video you will have a clear strategy that you can apply in your own trading, along with tips on how to manage risk effectively. So make sure you watch until the end to get all the insights you need to trade EURJPY with confidence. So without wasting any much of your time, let's get started. Let's start with understanding the EURJPY pair and factors that influence its price movements. So when trading the EURJPY currency pair, it's important to understand these key factors that drive its price movements. First, let's look at economic indicators from both the Eurozone and the Japan area. So this include GDP growth rates, inflation figures, and employment data. So when the Eurozone's economy is performing well relative to Japan's, the euro typically strengthens against the yen. So next, central bank policies play a crucial role. The European Central Bank (ECB) and the Bank of Japan (BOJ) set interest rates and implement monetary policies, and these implementations directly impacts the EURJPY exchange rate or price. So higher interest rates in Eurozone tend to strengthen the euro against the yen as they attract more foreign investments. So lastly, global risk sentiment significantly affects this pair. During times of economic uncertainty or geopolitical tensions, investors often flock to the yen as a safe haven currency, causing the EURJPY to fall. So conversely, when risk appetite is high, the euro often gains against the yen. So let's look at a major technical analysis trading strategy which you can use to trade the EURJPY. Let's dive into effective trading strategy for the EURJPY pair. So one popular approach is the trend following strategy, which capitalizes on the pair's tendency to form strong and sustained trend. Like this one in front of us, this is a very strong trend. So to implement this strategy, start by identifying the overall trend on the daily chart. Look for a series of higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. So this is the 4-hour chart. I'll just go to the daily chart to look at the overall trend, and you can see for this area we are entirely bullish. We are bullish for a very long time. As you can see, adjusting this, you can see that we are entirely bullish. There are so many bullish trend lines which we could use to take our trades. Okay, so now we've identified the entire trend, the overall trend. We are seeing that this could just be a minor pullback and we could be building up for a potential push to the upside, but it's not guaranteed, which is why we do our analysis as traders. So after spotting the overall time frame, the next is to use the 50-day moving average as a dynamic support or resistance level. So I'm just going to switch back to the 4-hour time frame, or I guess we could stay at the daily time frame. So I'm just going to go to the indicators and I'll search for the moving average. Moving average is simple moving average, and I'm going to use the 50-day moving average. You can also add the 200-day moving average. You can also add the 200-day moving average to help confirm price and trend changes. Sometimes price may go below the 50-day moving average, but it doesn't mean that the trend has changed entirely. Sometimes price likes to go to the 200-day moving average for to use it as its dynamic support or resistance level. So the 200-day moving average is the red line, while the 50-day moving average is the blue line. Alright, so once you've identified the trend, use the 50-day moving average and also the 200-day moving average as a dynamic support or resistance level. So in an uptrend, look for opportunities to buy when the price pulls back to this moving average. So let's start from this trend. We have this bullish trend we have right here. So we have price going above the 2 moving average, the 50-day and the 200-day moving average, and this signifies that we are now bullish. We have a pullback, and we have this pullback into the 50-day moving average. Now once you have a pullback into the 50-day moving average, it's important you confirm your trade before. Don't just go ahead and just enter a buy trade because it's in the 50-day moving average. So you just click a buy and just set your stop loss here. You might get stopped out. So you should confirm using several candlestick pattern to confirm your entry. Wait for bullish candlestick patterns such as hammer or engulfing pattern to form near the moving average, and this adds an extra layer of confirmation to your trade. For example, we have this formation here. We have, you can see this hammer. There is a hammer near this 50-day moving average. There is also an engulfing, a bullish engulfing candlestick pattern, which is this one here. I'm just gonna point it. We have, this is a bullish engulfing candlestick pattern. This is a hammer candlestick pattern, and is a bullish candlestick pattern, signifying that buyers are stepping in and there is rejection. There's growing rejection from this area, and we should be looking to buy. So after spotting these candlestick patterns, it's an indication that yes, indeed, we should be looking to place our buy entries from the close of this area. So I'm just going to use the hammer, the close of the hammer, and the confirmation candle close to it, closing above the hammer candle. So I'm going to set my stop loss below this level, this swing low we just formed. I might take profit levels at fixed risk to reward ratio, or like 1:2 or 1:3, depending on my risk appetite. And you can also see how price moved up for a 1:2 as we had that confirmation. So price can retrace even low as the 200-day moving average. So you should always be prepared. You can see this confirmation. We have this hammer candlestick pattern confirming that yes, this retracement, this pullback is due for a continuation. So we should be looking to place our buy entries right here with our stop losses below the newly created swing low, and we'll target 1:2 or 1:3 fixed risk to reward ratio. So just set your stop loss below the most recent swing low in that uptrend, or above the most recent swing high if it's a downtrend. For your take profit, aim for the next significant resistance level in the uptrend or support level in the downtrend. Remember, why this strategy can be effective: no trading approach is foolproof. Always manage your risk carefully and be prepared to exit if the trend shows signs of reversion. So as you can see here, we have another retracement back into the 200-day. Okay, we had a retracement into the 50-day moving average, but you have candles with lots of wick and shadows signifying uncertainty. It signals uncertainty when a candle has lots of wick and shadows, a series of candles with too much wicks and shadows, high wicks and high shadows, without being a full-bodied candle. So this signaled indecision in the market, and it was clear that this area wasn't going to hold. So we could wait for further retracements. You can also use combine this with your key support levels and resistance levels. Like this is a key support level which held and created a new high. So we could be looking for price to trade from this area of support. And also the retracement went on to the 200-day moving average. So you can see this engulfing pattern right here, confirming that buyers have started to step into this market, and we should be looking to take buy trades from this area. We are in an area of support. We are at the 200-day moving average, and also we have the bullish engulfing candlestick pattern. So that's enough for confirmation and for the conviction to take this buy trade. So take profits could be at this significant resistance level here, and this is a 1:2 risk to reward ratio trade. and that's how I've been able to take this trade. So we have another pullback. It's all about trading from the pullbacks. Like this is a pullback we have right here to the 50-day moving average, upwards, a pullback, upwards. So we'll be looking to take trades from these pullbacks. We're looking to take our trades from pullback areas like this. So that's how you can trade the EURJPY currency pair. So timing your trades effectively is crucial. When trading EURJPY, the optimal trading hours for this pair coincide with the overlap between the European and Asian trading sessions, typically between 7 a.m. and 9 a.m. GMT. So during this period, you often see increased volatility and liquidity, providing more trading opportunities. So we are on the daily time frame right now, and if you want to trade or enter your trades, you should be looking to enter between 7 a.m. and 9 a.m. GMT. You can also trade during the European session, which from 7 a.m. to 4 p.m. GMT, and this is particularly important when trading EURJPY. This is when major European financial centers are active and key economic data from Eurozone is often released. So pay close attention to announcements from European Central Bank during this time, as they can significantly improve or impact the euro's value. So another time you can trade is the Asian session from 11 p.m. to 8 a.m. GMT. So and this is crucial for EURJPY traders. During this time, the Japanese market is open and important economic data is released from Japan. So the Bank of Japan's monetary policies decisions typically announced during this session can cause significant price movements in the yen. So we've covered the technical analysis for EURJPY, and I believe this strategy can help you trade. Remember why these are generally the most active times for EURJPY. The forex market operates 24 hours a day, 5 days a week, so you can always look to spot opportunities, but it's just that the opportunities found in the Asian session, the European session, and the overlap between the European and the Asian sessions are more reliable than opportunities found on any other session, like the New York session. So by aligning your trading activities with these key sessions and being aware of important economic releases, you can potentially improve your timing and increase your chances of successful trades in the EURJPY market. Alright traders, you've come to the end of today's video. If you found this video helpful, hit the like button and subscribe to the channel. Turn on the notification bell for more Forex insights. Thank you for tuning in, and until next time, happy trading.